Alright, Chapter 1a. In this chapter, we will look at the public perception of protection cover and how the industry evolved in nature and practices to keep up with the rapid pace of societal change. But first, in 1a, let's make sense of insurance and how it fits the wider financial planning process. When planning finances over a lifetime, it's important to realize that problems can and will happen along the way. From work injuries, road accidents, job loss, thank you COVID, to death, the road is bumpy and ridden with all sorts of risks. This is a fact. So what we mean by financial protection in this module is the range of insurance contracts that provide financial sums in the event of long-term illness, disability, or death. It's as simple as that. Quick focus point. When we speak of risk in this context, it's crucial to determine the two types that exist out there. Some risks are best managed, while others are best insured. So let's understand this in more detail. First, we have managed risk. Think of every time you cook a meal. The precautions that you take while maneuvering the kitchen knives is what we call risk management. You make sure not to cut yourself, essentially. The fact of having a first aid kit is also risk management. In the case where you harm yourself, you rush and open the first aid kit and voila, the problem is gone. So in the case of cutting one's skin while cooking, the precaution before and after fall under risk management. Other examples of this are footballers wearing shin pad in football, or helmets and tooth guards in rugby, or even simpler than that, locking the door behind oneself when entering or leaving the house. You're taking precautions against some risks, so you are managing those risks. Other risks, however, are best insured. This is because maybe they're too unpredictable or too large to manage and cumbersome to manage on a daily basis and are therefore best insured against. Let's take an example of a piano falling over your head as you walk down the street. You just can't live in constant fear of this happening, nor can you take precautions at all times to stop it happening. So what we do is we can buy accident or death insurance. In a less silly note, however, and to take the simple case we took earlier, one can lock their front door as much as they want. The risk of someone decided to intentionally break into your property and steal your valuables remains present, and therefore, as much as one can take precautions, you still have to take an insurance product called contents insurance in this case that insures against this risk, that of someone breaking into your house. When thinking of risks and the possibilities that exist out there, I find this matrix useful to help me think whether they fall under the managed risk type or under the insurance type. You can see these 4 quadrants right here. On the top left, you have the low frequency, high impact. These are things that happen very rarely, but the impacts of which can be devastating. So think of a house burning, for example. It doesn't happen every day, but when it happens, my goodness, the cost of buying a new house or fixing and rebuying literally everything that is in there is tremendous. So it's best to insure against this kind of risk. And in this quadrant right here, the main risks that most people face are disability, critical illness, and death. And it's best to insure against these 3 specifically. Moving on to the top right, high frequency, high impact. These are things that happen quite often and have devastating impacts. Some jobs, for example, have high turnover. They have a high risk attached to them. And this is, for example, someone who works as a contractor. They are out of work frequently, and the impact of being out of work is also huge. So what you do in this case, instead of insuring against something like that, which can be very pricey, what you do is you manage this type of risk. How do you do that, you ask? Well, if you work hard, if you make yourself essential, if you have an emergency fund in place to mitigate the financial risk, then you're essentially managing this one. Moving on to the bottom left, this is low frequency and low impact. These are things that happen rarely, and when they do, they're quite insignificant really. Think of whenever you're cooking and you happen to cut your finger. It doesn't happen every time you cook, but when it does happen, it's not the end of the world. You don't have to go to A&E, you simply put a band-aid on. So the way you manage these risks is by having a first aid kit or by being very cautious when maneuvering kitchen knives. And the last one, bottom right, high frequency, low impact. These are things that happen quite frequently but are quite insignificant at the same time. Think of every time you injured yourself while walking around the house, or paper cuts, minor injuries. These are things that happen quite frequently, but the impacts of which can be either managed by being cautious or simply ignored. Their impact is so little that they can be ignored. Moving on, we mentioned early death a while ago. A newborn baby boy nowadays can expect to live to 79 years. A baby girl, however, 83. Take that equality. This means for us that newborns will make it to retirement, but it's a fact that a lot of them won't. So the risk of early death is therefore real and important to have some sort of financial protection against. This is especially important to mitigate the financial impact of early death on family, dependents, and other financial commitments that need to be met. Having said that, this type of insurance is much cheaper than most people think. This is due to the survival rate, first of all, and the longevity of life that people in the UK enjoy. This translates into many people contributing, but very few making claims, and what this has as an impact is a downward pressure on the price. In conclusion, the UK protection industry is the third largest in the world behind the US and Japan. For us, this means that everything is in place for people to insure against the many risks that exist out there. And yet, official studies find that most people are underinsured if they are insured at all. And since we're likely to recommend protection to our clients and customers one day, here's an exercise I recommend you do. We said earlier that death and disability are the main risks that most people face, and therefore our top priority as far as insurance products go. Think of what would happen if you were to pass away tomorrow, or have an accident at work that makes you unable to ever work again. What financial commitments would fall on your spouse or civil partner? What mortgage payments need to be met? Do you have any car finance? How much would it cost to remodel your house to make sure that you're able to fit a wheelchair in? And once you think of all of that, go out there and look up a quote. As simple as that. See how much it would cost you right now to insure against this risk in the unlikely event where it happens. I think you might be in for a surprise.